All right, this is a topic we've covered before, but it's a difficult one, so it probably bears repeating. This video is about partnership loss limitations. So, of course, one thing we've realized by now is that operating losses can generate current tax benefits because a partner can deduct them against their other sources of taxable income. So ordinary losses from a partnership are deductible against any type of taxable income. But losses are only deductible if they meet three separate hurdles: the basis, the at-risk, and the passive loss limitations. And by now we know those have to be taken in the order in which they're listed. First you get through basis, then through at-risk, and then lastly through passive. So the tax basis limitation is, in a sense, a partner's basis represents that amount the partner has invested or may have to invest to satisfy her debt obligations. And the partner may not utilize losses in excess of their basis in the partnership interest, so their outside basis. Losses in excess of that are suspended and then carried forward indefinitely until the partners have sufficient basis to utilize the losses. Lastly, partners can create additional tax basis by making capital contributions. So the at-risk limitations. So the at-risk is more restrictive when compared to the tax basis limitation. Go back to Chapter 7. It's not really that much more restrictive. The primary difference is the ability to use non-recourse debt as a way of creating tax basis. Non-recourse debt cannot be at-risk amount. That limits the partner's losses to their at-risk amount. So there is that thing called qualified non-recourse financing. We talked about that back in Chapter 7. That can create at-risk amount. So basically, partners are considered to be at risk for what they've invested, plus the recourse debt and any qualified non-recourse debt that has been allocated to them. So the passive activity loss, this is the final backstop for if the basis and at-risk rules don't pick it up. It applies primarily to individuals, but it can also apply to estates, trusts, some closely held C Corps, and personal service corps if they're acting as partners. And it limits the ability of partners in rental real estate partnerships and other partnerships that they do not materially participate in from using their ordinary losses from those activities. So everything kind of depends on that definition of material participation. So this should look somewhat familiar. Molly acquired a 30% interest in the BG partnership for $48,000. Her share of the recourse debt was $50,000. And then in 2017, it repaid debts of $60,000 and made a cash distribution of $10,000 to Molly. And in this case, we're just going to say, to make it simple, the partnership broke even in 2017, so there was no loss or income allocation to Molly. So Molly acquired this interest, which means it was just purchased. She didn't contribute property. So her basis is initially what she paid for it, so that's $48,000. Then she gets to include her share of the debt, which is listed as $50,000. And then during the year, they repaid debts of $60,000. So her share of that is 30% or $18,000. That reduces her basis by the $18,000. Then it makes an actual distribution of $10,000 to her, lowering her basis down to $70,000 at year end. So if in 2018, BG incurs an ordinary business loss of $300,000 and makes no distributions and no debt payments, well, Molly's allocation of that loss is $90,000, but she only has basis of $70,000. So as a result, her basis is taken down to zero, and that additional $20,000 is suspended pending some form of increase in basis that goes beyond. Now, notice the at-risk amount is the same. So I want to deal with this in a chronological way so you can see how these limitations apply in order. Because each limit is like a cake layer. If it doesn't get through the higher level, it's not relevant at the lower level. So think of it as each layer is a screen that only so much can get through. So let's start with the basis column. right? So basis starts at 70,000, the loss is 70,000, which means that the ending balance is 0. 70,000 is passed through. The filter, that first filter, let's call it the basis filter, but the other 20,000 is suspended. Okay, now let's shift down to the at-risk limitation. Because only 70,000 got through basis, then at the at-risk level, we only consider 70,000. 90,000 isn't even on the board. Our loss is 70,000. We had an at-risk amount of 70,000, so we zero that out, and all 70,000 passes through, with none being suspended at the at-risk level. Then lastly, we have a $70,000 going into the passive loss limitation. Since we didn't have any passive income, all 70,000 is suspended. Okay, now in 2019, BG generates income of $40,000, and Molly makes a $6,000 cash contribution. And on top of that, the partnership borrows an additional $20,000. So recall that we finished last year with a 0 basis amount and a 0 at-risk amount. So the first thing that happens is the contributions are going to be baked in. So that's $6,000 of her cash contribution. Her share of the borrowing is another $6,000 because she's a 30% partner. So that's a $12,000 contribution. Her share of the income is also $12,000, right? That's 30% of the $40,000. So now we're up to $24,000, which means that we can start to use the suspended loss item. So the first thing we do is push the loss item through the basis limitation. So since we're up to 24, we use 20 of that. Our basis at the end of 2018 is 4,000. That same 20,000 loss, even though note we did not incur a loss in 2019. That's just last year's suspended loss. It pushes now into the at-risk filter. Well, since our at-risk amount is up to 24,000, we can use all 20,000 of the suspended loss from the basis, which as a result now we're left with 4,000 in the at-risk amount. Now we get to the passive loss limitation. So notice we had 70,000 suspended from last year. We've got another 20,000 we add this year, no passive income, except for the 12,000 of income that we generated from BG. Well, the 12,000 of income we're going to offset with a 12,000 suspended loss, and technically it's FIFO basis, but neither here nor there. So we net to 0, but that would leave us with 78,000 still suspended under the passive loss limitation rules. So here's a chart that shows the test for material participation. We showed this in Chapter 7 as well. Again, it's not something that you really need to memorize. So you can see that we bucket these incomes into the three things. This is also a reflection back to Chapter 7. So we have passive income, which is income from an activity in which you don't materially participate, or rental activities. There's portfolio income, which is dividends, interest, rents, and royalties. And then there's active income, which is what we think of as trader business or production of income. Okay, that brings us to the end of Video 20G. Thanks for watching.